I'd like to welcome to our class today, IAS2, which is specifically for ICAN students writing financial reporting. It's also worth mentioning that this is also applicable a bit for the corporate reporting student, just that IAS2 is not a standalone standard that will be tested, but it can be tested probably under the group accounting one. It can also be tested if maybe under some other standard like IAS 8. Okay, so briefly, I'll be going to just talking a bit about inventory. Then afterwards, we can look at the objective, scope, and definition of IAS2. First, it is worth noting that inventory is not a difficult standard and it's quite very simple, not too comprehensive and not too complex. So let's start with that. So first, we need to know that a whole lot of companies, most especially the manufacturing companies, they have inventory. We have different types of inventory. We have the raw materials, we have the finished goods, we have the work in progress. We have a bulk of that. But then, how do we account for these? How should this be accounted for? Imagine getting an inventory in January, or let's say in July, and your year end is December, and you're planning to sell them, but then you've not been able to sell them at the end of the year. Now the question is, at the end of the year, what is the cost of those inventory? Or what is the value of those inventory? How do you go about valuing those inventory in your book? Now the reason for this is because we are in a world where the prices of things change easily, and we're in a world where the inventory can also probably not be in a good state. Hence, the need for you to value the inventory at an appropriate amount, because you shouldn't be overvaluing your inventory and you shouldn't be undervaluing your inventory. That is why if your inventory has a damage, if your inventory is damaged, then you know that you actually need to value it at a lower amount compared to the amount you actually bought it. Now, don't forget, these are all basic things that we learned early in accounting, where we talk where you need to recognize the loss as soon as you've made the loss. So basically, that's what we'll be looking at, and that is the essence of this IAS2 standard. Now, what are the scope? What are the scope of the standard? Now, it's very simple. Inventory comprises of raw material, like I said earlier, production supplies, work in progress, finished goods, good in sellable condition. Now, the standard intentionally states that this particular standard, which is IAS2, these are the typical example of what you see as inventory. Now, how about the scope and recognition criteria? Now, it is also important for us to know that inventory should only be recognized when they meet the definition of an asset. Now, don't forget, in the conceptual framework, you must have learned what an asset is, a liability, income, expenses, and equity. So I'm not going to be going into details about that. But then inventory should be recognized when they meet the definition of an asset as set out in the ISB framework, International Accounting Standard Board framework. Now, no additional guidance on the timing of recognition is provided in IAS2. So IAS2 did not provide any additional guidance on recognition of inventory. Now, what are the scope of IAS2? IAS2 comprises of all types of entity, right? Inventory in all types of entity, but actually some inventories are excluded. So what am I saying? IAS2, you can use IAS2 for all entities that have inventory, but then there are now some inventory that are excluded from the scope of IAS2. Now, majorly, they are just two inventory. Now, the first one is the financial instrument. Now, financial instruments is excluded, right? Anything, for example, there are some financial instruments that financial institution buy and sell on a regular basis, which technically look like an inventory, but then it is outside the scope of this standard because there's a specific requirement for such under financial instruments. IAS 9, sorry, IFRS 9, then IAS 32. These two will guide you on how to go about financial instruments that are inventory in nature. Now, the second one is the assets related to biological assets related to agricultural activities and agricultural produce at the point of harvest. Now, this is also dealt with under IAS 41. So these two is actually excluded from the standard. Kindly take note of that. Now, I added here that for the avoidance of doubt, note that the requirement of IAS to apply in their entirety to property intended for sale in ordinary course of business. For example, all this company that does selling of properties, land, if that is their ordinary activities, then those properties that they sell on a daily basis, on a regular basis, should be accounted for under IAS 2. That is what we're trying to say here. Now, or in the process of construction or development for such sale, e.g., property acquired exclusively with a view to subsequently dispose them in the near future or for development and resale. Now, two, it's also worth noting that inventory held by producers of agricultural and forest products, agricultural produce after harvest, and minerals products, when they are not measured at net realizable value in accordance with well-established practices in those industries. So we are saying that you still apply this standard in cases where in a particular industry, you don't need to measure using net realizable value. Then you continue with your costs. Now, we move to the next thing. Now, how do we now value all this type of inventory that we've looked at, apart from those that are scoped outside the IAS 2 standard? Now, inventory should be measured at the lower of costs and what? And realizable value. Inventory should be measured at the lower of costs. So take note of that. Lower of costs and net realizable value. That is what the standard has asked us to do. So let's take note of that. Inventory should be measured at the lower of cost and net realizable value. What does that mean? It means that whichever is lower between the cost and the net realizable value, that is how you should measure, that is what you should measure that is how you should account for the value of your inventory. Now, all things being equal, naturally, your net realizable value should be greater than your cost. But then we have some situation where the net realizable value is always lower than the cost. For example, when there's a damage, for example, when there's when there's a loss in value of a particular inventory. Take for example, those days where they sell desktop, and when laptop came into existence, there would have been a loss of value. Or you can take a typical example, iPhones. When there's a new iPhone in town, the value of the old one typically will go down. That is a typical example of how a net realizable value can be lower than the cost of an inventory. Naturally, this should not be the case if you have a proper inventory management system. Okay, now I'll move on here. Value inventory at the lower of cost and net realizable will ensure that any profit to be earned on the sale is not recognized before the sale takes place. So we are saying that, if your net realizable value is greater than cost, you are not expected to recognize the value of that inventory at net realizable value because you've not actually sold it. At that point, the cost is lower. Therefore, you should recognize the value of the inventory at the cost value. But in other way, if it is the cost that is higher than the net realizable value, whether there's a damage or anything, then you have to recognize your inventory at a lower value, which is going to be your net realizable value. Okay. Although any loss is recognized as soon as it is identified. Don't forget prudency concepts. Early on in our understanding of accounting, you've looked at prudency concept where you have to recognize loss as soon as you make them and recognize profits until it is realized. Loss as soon as it is identified, profit it is until it is realized. Okay, so that is the principle behind IS2 valuation. Now, we need to look at this too. How do you account for your costs? How do you get your net realizable value? We are going to be looking at those two shortly. First, what are the things that should comprise your cost of inventory at the date you're buying it or at each particular point? Now, the purchase price, now don't forget, the cost I'm talking about here is different from the value of the inventory. Value of the inventory is at the reporting date, what is the value? What is the amount you are, what is the valuation of the inventory? So what comprises of the purchase cost? First, you have the purchase price, you have the import duties and other taxes. Probably you are importing something from another country. The import duty, the taxes that will be charged on those goods by immigration. These are typical examples of the import duties we're talking about. The carriage inward, that's the transportation, any cost of carrying those inventory in. But your inventory should exclude trade discount, rebate, and similar deduction. So we are saying that when you get a rebate or sales discount on your inventory, you need to actually reduce it from the cost of your inventory, which means that you should not add it to the cost of your inventory. Now, that is the purchase price. Now, if there's a conversion along the line, probably you bought raw material and you want to convert them into finished goods, you also need to include your conversion cost. And a typical example of your conversion cost is cost directly related to units of production, e.g., the labor, the direct expenses, and subcontract costs. These are things that should form part of your inventory costs. 2, systematic allocation of fixed available production overhead. 3, fixed production overhead. 4, in period of abnormally high activities, fixed overhead allocation per unit should be reduced to avoid any violation of inventory. Other costs are included to the extent they are incurred. Now, please take note of this. Other costs are included to the extent that they are incurred in bringing inventory to the present location and condition. Kindly take note of that. Because as an examiner can come in and just twist the question, trick it a bit, and add something similar to this, and tell you some costs that was probably incurred that does not even relate to that does not relate directly to this inventory, then at that point, you shouldn't be adding it to it. For example, if there's a fixed cost in a particular factory, now you shouldn't add the total fixed cost to the inventory. That is where we now say you add the fixed production overhead that are allocated on the basis of normal activity. Now, what are the valuation method, the cost valuation method that we have? We have the actual costs. This is just the amount you bought the inventory, bringing them, including the carriage inward, of bringing them into the factory or wherever the location where they are. Now, let's just go through what the note is saying. Actual costs, where inventories are not freely interchanged because they have been made to an individual customer specification. This cost should be actual expenditure incurred. First in, first out. These are things that I know that we're familiar with. This method assumes a physical flow of items whereby those purchased or produced earliest are first to be sold. The ones who purchase first, they are first to be sold. You are just assuming when you're valuing the cost of your inventory. Now, the item purchased or produced most recently are the ones in the inventory to be valued at the most recent cost. Weighted average, this is a bit different from first in, first out. This method calculates an average cost of purchase or production calculated either on a periodic basis or after each shipment has been received or new batch has been produced, and value eventually at the average cost. So what we're saying here is, let's assume that you have 10 units of inventory costs valued at 100 naira. Then you had dead additional 50 valued at 60 naira. We are now saying that the value of the inventory per unit is going to be 100 plus 60, which is 160, divided by the unit, which is 100 plus 50, divided by. So we are saying first you bought inventory 100 units for 100 naira. Then next, at this point, this is the value of the inventory. Next, you bought 50 units for 60 naira. We are saying that the value of the inventory is going to be 100 plus 60, which is 160, 100 plus 50, which is 150. The unit cost of your inventory is going to be 160 over 150. That is what we are saying here. Now, let me quickly press a calculator for that. 160 divided by 150, which is going to be 1.07. That is the value of your inventory per unit using weighted average cost. Now, weighted method is quite simple. Simply sales value less the appropriate gross margin. Sales value less the appropriate gross margin. That is the retail. That's the retail method. Now, replacement cost. This is often used when maybe in the gold, when you're selling gold and some natural resources. Now, use where an active market exists. Not unusual in valuing commodity. Yeah, I meant commodity at the time, such as gold. Then lastly, it is very important that we know this, that LIFO, last in, first out, it is not acceptable by the standard. So if you are complying with IFRS, you are not expected to use IAS 2. I'll take that again. Last in, first out is not acceptable under IAS 2. Please take note of that. Now, benchmark is either, please take note of this, is either FIFO or weighted average cost. But in the interest of truth and fairness, any method may be used based on judgment. An entity shall use the same cost formula for all inventory of a similar nature. We are saying that if you are using FIFO, you have to use FIFO for all types of inventory or for the same kind of inventory that you have. It's not as if you use FIFO for one set of your inventory and use weighted average for another. We're saying that for that particular set of inventory A, you have to use FIFO for them or weighted average for all of them. Now, the concept of net realizable value. So that brings us back to the fact that we are done with it, with the cost, how to value cost of an inventory. Now, let's look at the net realizable value. Now, net realizable value is the selling price expected to be achieved less an estimated. So now, let me just have this noted down. Net realizable value is equals to your selling price. Some people will say fair value. Less what? Less the estimate of cost to complete. Less cost to complete the production of the goods, comma, right? And the cost incurred to sell them. So these are the two. This is this is how to derive your net realizable value. So your net realizable value is your selling price less cost to complete and the cost incurred to sell the inventory, like the estimated cost to incur to sell the inventory. In most cases, these are always estimates, right? And this is always the fair value in most cases. Please take note of that. Okay, now we are saying that the key point to note with regards to net realizable value are that in the case of incomplete item, net realizable value takes account of cost to complete. It makes it just like I already explained that. Let's say, for example, you are looking at an inventory that is still work in progress, and you're looking at, oh, if we are to sell it, what is if we are to value it at net realizable value, what is the fair value? You look at it, the fair value is likely going to be the fair value of a finished good. Then you now take into consideration my inventory is still work in progress. How much do I need to spend to complete it so that I can form a basis for comparing it with the fair value of the finished goods? Then what is the cost I'm going to incur to sell it? In making the assessment of whether net realizable value is lower than cost of inventory, right? It may be appropriate to group items together. Now, this is very, very important. We are saying that when you are doing your net realizable value, it is important that you group your inventory together. For example, you can have inventory A, inventory B, inventory C. We are saying that it is appropriate that you do what? Let me tell you that again. In making the assessment of whether NRV is lower than the cost, whether this is lower than the cost of the assets of the inventory, you need to do what? It may be appropriate to group items together. All inventory A, all inventory B, all inventory C. Don't aggregate them. It means that I need to check what is the net realizable value of A, right, versus the cost of A. Net realizable value of B versus the cost of B. Net realizable value of C versus the cost of C. Don't do aggregate of what is the cost over no. This is not allowed. You do it on an individual basis. A, cost versus net realizable value. B, cost versus net realizable value. C, cost versus net realizable value. Then, in some cases, it might be impossible to do that. Let's look at what they say. However, items should only be grouped together when the individual items can be valued separately. So if it can be valued, if A can be valued separately from B, can be valued separately from C, then you should have that separate. You should have that separate grouping of A together, B together, and C together. It is not appropriate to treat a whole class of inventory, for example, all goods held for sale, as a group. Let's imagine that A, B, C, they are all inventory, and you want to just have the aggregate amount compared to the cost. No, we are saying it is not appropriate. Now, if the net realizable value is less than the cost, the write down of the inventory will also be made on a group basis. Okay. Now, in the absence of contractually agreed selling price, the best estimate is likely the selling price. We are saying that if it is impossible for you to get what the fair value is, the selling price, then we are saying that the best estimate is likely the selling price, less appropriate deduction. And lastly, materials to be incorporated into a finished good should only be written down if the eventual finished good should be sold for less than the total cost. So basically, that is just the principle behind net realizable value and the cost value comparison. Now, it doesn't make any business sense for your net realizable value to be lower than your cost. Nobody wants to make loss, but in some situation, we have that. Now, in what possible situation do we have a net realizable value that is lower than cost? One, an increase in the cost or a decrease in selling price. Maybe you're doing a promo, or maybe a competitor came into the market and reduced the price of its own good. And for you to survive, you also have to reduce the price of your own good. So take note of that. Inventory is no longer in best physical condition. For example, you have inventory of books or of flour and water poured on it. Now they are not in a good condition. Nobody wants to buy that for the exact price. Everybody wants to get a discount on that. So it has affected the net realizable value. Finished inventory is now technically obsolete or out of fashion. Take note of that as well. The comparison between two versions of two versions of an iPhone 13, iPhone 14. Because iPhone 14 is out, the price of iPhone 13 will drop. Or take, for example, I think that's just a very good example. Then the next, a strategic management decision to sell goods at less than cost. Probably just to ensure that you have enough customers. You make more customers. You get more customers. So with that, management might decide to reduce the selling price of a particular inventory. And lastly, errors made in purchasing or production. So those are the possible ways that the net realizable value of an inventory will be lower than the actual costs. So with that in mind, we'll quickly look at an illustration, just an illustration for the valuation of inventory. Now, illustration one, I'll read. Manufacturing costs in 2007 for inventory held at the year end, 31 December, are 120 naira, 120 million naira. All goods held at the year end were sold on 1st January 2008 for 100 million. The selling cost incurred for the goods sold in January 2008 were 8 million. What is the value of the closing inventory at the reporting period of 31 March 2007? Let's not forget, what we are still saying is inventory should be measured or should be valued at the lower of cost and net realizable value. Now, this question is saying that in 2007, there was an inventory that was bought for 120 million, and they were still held at the year end, but were sold the following year for 100 million. Now, what is the cost of the inventory from this question? The cost of the inventory from this question is 120 million. The cost of the inventory is what? Is 120 million. $120 million, or better still, let me just have it that way. Right? Okay. Now, this is the cost of the inventory. Now, what is the net realizable value? Don't forget, net realizable value is the selling price less minus the cost to sell. Now, in this case, we know what the selling price is. The selling price, we're told, is 100 million. 100 million minus what? Now, looking at the question, they said the selling cost incurred for the goods. Now, your cost to sell are those costs you incurred in the process of selling, likely costs you incur in the process of selling that particular inventory. And in this case, when they were selling this inventory eventually the following year for 100 million, now they were able to sell, they were able to incur, or they incurred a cost of 8 million. Now, in some cases, the examiner will tell you that it is an estimated cost. So it's not a problem, but just go along with what the examiner has asked you to do. Now, it means that the net realizable value in this case is what? Is 92 million naira. Now, looking at this, we can see that the cost, right, of 120 million is what? Is greater than the net realizable value. And don't forget, inventory should be what? Inventory should be measured, should be valued at the lower of the two. So therefore, we are going to say that the value of our inventory should be written down by 8. Sorry, did I say by 8? By 18 million. Now, I will explain that. What am I saying in essence? The value of our inventory is actually, inventory is or should be valued at 92 million. Now, what do I mean by the 18 million written down value? Initially, your inventory would have been written as 120 in the books, but now you want to write it down to 92. It means that you have to do what? You have to debit and credit what? You have to credit your inventory, because you are now writing down your inventory from 120. You're writing down your inventory from 120 to 92, which is a difference of 18. Then you credit your P or L with 18. That is that about the valuation of this inventory. Okay. So it's not a difficult thing. What is the value of the inventory at the reporting date? The value of the inventory is what? Is 92. For you to account for this, this is the accounting entry to do that. Because in the accounts or in the trial balance of the company, they would have recorded inventory as 120. But now, because you're trying to value it based on IFRS, IS2, you have to do what? You have to debit your P&L and credit your inventory with 18. Okay. So that's that about that. That will take me straight to illustration 2. Now, illustration 2 is a bit more, not complex, but then it brings about the fact that we said inventory should be the comparison of the cost and the cost and the net realizable value should be done on an individual grouped basis, like product A compared with actual cost of product A versus the net realizable value of product A, right? Instead of just having all inventory costs and the net realizable value. No. So this question 2 is going to illustrate that clearly. Now, FALCO inventory include 3 items for which the following details are available: supplier list, net realizable value. And we have the 3 different types of products: product active, product brassy, and product shield. Now, the company received a discount of a trade discount of 2.5% from its supplier, and it also takes advantage of 2% discount for prompt payment. Required, calculate the total value of product Arctic, Brazil, and Chile, which should be shown in inventory in the statement of financial position. Now, I'm just going to let's just look at the question before I start solving it, just like 1 minute before I start solving the question. Okay. Now, coming back to the question, this question is telling us we need to do two things. We need to value the cost of the inventory. Then also, we also need to do what? We also need to do the valuation at the end of the reporting period, value the actual cost of the inventory, then, or account for the actual cost of the inventory, then two, what is going to be the value of the inventory that will be accounted for in the financial position. Indirectly, two things we are just going to do. We are just going to have the actual cost, net realizable value, then we do the comparison and know if we are to carry it at the actual cost or at the net realizable value. So first, looking at the question, there is something I want us to take note of. One, 2.5% discount and 2% discount. Now, this is cash discount. This is trade discount. They are two different things. They are two different things. Just a minute. They are two different things. Now, when we're looking at what comprises the cost of an inventory, we said it should exclude trade discount, rebate, and similar deduction. But we did not say that it should exclude what? Cash discount. So it means that we are not to bring in the effect of this cash discount does not affect us. We are only bothered about the trade discount. So what am I going to do? Let's look at it this way, right? Let me expand it a bit. Yeah, let's look at it this way. I'm going to have my product. Allow me to use product A for Arctic, product B for Brazil, product C for Chile. Then I look at what is the value of my cost. My cost is less 2.5% discount, right? Because of space, I have to do something, right? Now, this cost, right, is going to be less trade discount. Then I have my net realizable value as given to me, right? Then I have my valuation based on the principle of IAS 2, the lower of the two. So let's put the currency on top of it. Now, product A, let's look at it. What is the cost that was given to us for product A? Let me just have a workings here that will help us. Product A. Actual cost, they said, is 3,600, right? Then there's a discount of 2.5. It means that my actual cost is going to be 3,600 times 97.5%. How did I get 97.5%? 100% minus 2.5%. It's as simple as that. Now, 3,006 times 97.5 will give me 3510. And I can come here and put 3510. As simple as ABC. Product B, actual cost automatically becomes what? We are saying it is 2,900. Same principle applies because it said that for all the product, they get a 2.5% discount. 97.5%. So let me get my calculator. 2009, then it's 97.5. Then I have 2827.5. So let me write that, let it show a bit clearer. So that is 2827.5. Now, what is the next thing that we do? We do that of what? Product C. Product C is 4,200 times 97.5%, since they get 2.5% discount on all of their products. So we are going to keep doing that. 4,095. That is 97.5%. That gives us what? 3,992.6. Right? Hold on. Yeah? Just a moment. So the company receives a 2.5 trade discount from its supplier, and it has taken advantage of this. Yeah, that's correct. So we are going to have 4,095 times 97.5, which is what? 3,992.6. Now, automatically, I come up here and just have what? 2827.5, 3,992.6. Now, I make a comparison with what? With my net realizable value given to us directly in the question. If I'm correct. Sorry, did I just say 4,095? Sorry, I have to go back to this. It's 4,002. I made a mistake. 4,002 times 97.5, which is 4,095. So this is wrong. So let's quickly work that back. This is wrong. This gives us 4,095. Apologies for that. Okay, so we have a 4,095. Right. Now let's just quickly bring in our net realizable value. 5,100. Sorry, my handwriting is very, very good. Yeah. We have 5,100. We have 2,800. We have 4,100. Now we have to do what? The principle is the lower of these two on an individual basis. Now, this is where that grouping we talk about. This is where it is important that we reflect on it. The standard is not saying that you do the grouping on by adding 3,510, by adding this plus this plus this and compare with adding. No, you have to do it on a line by line basis comparison. You have to do it line by line comparison. What do I mean? Let me just take that back. I'm saying that you do this versus this versus this versus this. Don't do comparison of this versus this. No, no, that is not going to work. So we are going to do that, which is lower. Net realizable value is lower. 3510, which is lower. Net realizable value is still lower. Sorry. For the first one, the cost is lower, not net realizable value. 3510. For the second one, 28, right? 28, which is what? 28 is actually the net realizable value. In this case, the net realizable value is lower. So I bring in the net realizable value. Then for the last one, the cost is actually lower. So I add this up, and that gives us the value of our inventory. 3510 plus 28 plus 4095. That gives us what? 10405. It's as simple as ABC. That is the value of our inventory. Now, let's just quickly go back and look at the assumption, the other assumption, that it should be grouped. It shouldn't be grouped together when you're comparing cost and net realizable value of all inventory. Or let me put it this way: you shouldn't group all inventory together when you're comparing the cost and net realizable value. Now, this will just give you an idea of what the difference is. Now, looking at this, I'm going to add all the costs together, right? I'm going to add all this together, then add all this together, then we can now see which one is higher. 3510 plus 2827.5 plus 4095, that will give me 10432. Then 51 plus 28 plus 41, that will give me 12,000. If you are going to be doing it on this kind of aggregate level, the standard asks us not to do it on this level. If you're going to do it on this kind of aggregate level, then you would have said, oh, the value of my inventory is 10432, which is different from the actual value that the standard asks us to use, which is on an individual basis, which is 10,405. In essence, we are saying that this is the best way to go about it. I hope that is clear. I'm going to revert and delete all these other ones because we do not need them. Or probably we just need that of the cost alone. So it means that the value of my inventory will be written down to 10,405 from 10,432. It's as simple as that. Now they said calculate the total value of product D, product ABC, which will be shown in the inventory of the financial position. Now, what is the value that will be shown in the inventory of the financial position? This 10,045, and this is the breakdown of such. Okay, so that is that about that. You just have one more question to solve, but before we do that, let's just go back a bit. Now, recognition as an expense and disclosure. This is just going to be very fast. Once an item has been sold, it is removed from inventory, and that is why you have to add it as part of the cost of your sales. Because why is it even removed from the inventory from asset is because it no longer meets the definition of an asset. It is therefore treated as an expense in the accounting period in which it is sold and related revenue recognized. Don't forget, all these things we've learned in the conceptual framework. Matching concepts, when you match the cost and the revenue in the same period. Now, any amount of write down of the inventory to net realizable value should be recognized as an expense in the period when the write down occurs. And that is what I was trying to say here, that this write down should be debited to your P&L 18 in the case of the first one. Now, Disclosure. Accounting policy used in measuring inventory, including the cost formula, you have to disclose that. The total carrying amount of inventory appropriately classified, like the breakdown, just like we have in this illustration too. Then the amount of any reversal of previous write-down circumstances which caused the reversal, if there's any. Then the carrying amount of inventory promised as security for debts. So that's that about the two questions so far. We're going to look at this practice question, which is a little bit technical, but not too hard. We're going to look at that shortly. So we're going to look at practice question. Now, I'm going to read the question, and I will be underlining some things while I read the question. Just bear along with me. On 30 September 2014, Razor's closing inventory was counted and valued at the cost of 1 million. Take note of that. It was valued at the cost of 1 million. Right? Now, some items of inventory which had cost 210, take note of that, had been damaged. Now, immediately you see the word damage, something should be reflecting. In a flood on 15th September 2014, which is before the end of the reporting period, because this timing also a bit is going to be affected in the case of IAS 10, whether it is an adjusting event or non-adjusting event. That is another standard entirely. I'm not going to be moving into that. Now, and are not expected to achieve their normal selling price, which is calculated to achieve a gross profit margin of 30%. They are saying that, what this question is saying that this particular inventory that is valued at 210 or that costs 210 is not going to be sold at the initial selling price. And with the initial selling price, we are saying that we are expected to make 30% profits. Right? The sales of these goods will be handled by an agent because it has been damaged. You now feel like, oh, let's give it out to an agent that can help us, that understand people, that understand the market, that can help us speak to the people in the market. Right? Now, okay. So, the sale of these goods will be handled by an agent who sells them at 80% of the normal selling price. The normal selling price is the 30% gross up, and charges Razor a commission of 25%. That is a typical example of what? Cost to sell. Now, at what value will the inventory of Razor be reported in its statement of financial position as at 30 September 2014? At what value? We're going to be solving this shortly. We are going to be doing this together. Now, we need to take it step by step. Don't forget, inventory should be valued at what? At the lower of cost and net realizable value. Now, this is Razor. Let's just use limited, right? This is going to be the cost. This is going to be the net realizable value. And this is going to be the valuation. Okay, thought I've lost it. And this is going to be our valuation. Now, it's simple. First, there's a total inventory that worth 1 million. And then, sorry, let me just put this. There's a total inventory that worth 1 million. And two, there's another set of inside that 1 million inventory, there's a portion of it that is worth 210. So it's just like you have A, B, C, 1,000. But B is having a problem and the value of B is 210. So we are actually testing the inventory of B, which is that value 210, as an example. Okay. Now, if the value of the inventory, so it's safe for me to put total inventory 1 million, or let me change this to 1,000. Yeah, let's just change it to 1,000. 1 million. And so here we are going to have something like damaged inventory. Damaged inventory. Now, what is the cost of the damaged inventory? Let's just call it inventory D. We don't know what it is. Let's just call it inventory D. The actual cost of that inventory we're told is 210. That is this, right? 210. Now, they said it has been damaged in a flood, and they are not expected to meet their normal selling price. Now, 210 is the cost. The selling price, we have to look for it. Why? Because they said eventually they were sold at 80% of their selling price. So we need to get the selling price. How do we get the selling price? We're told that the gross profit margin that the company expects to achieve to realize the selling price, right? The original selling price before the damage is 30%. If you can remember, gross profit margin, margin is on sales, right? And markup is on cost. Convert 30% to margin, sorry, to markup. So it's as simple. Markup conversion from margin. Margin is equals to what? Because these are little things that we need to take note of before we can solve this question very well. Now, margin is profit over sales, which is equals to profit over cost plus profit. 30 over 100, right? Now, my markup is profit over cost. It can be assumed that this is profit and this is cost plus profit. It means that my cost is 70 and my profit is 30 to equals 100. So definitely I can say that my markup is 30 over 70. Now, for me to achieve the selling price now, or for me to know the profit, I know that my markup is 30 over 70, and I know what the cost is. So 30 over 70 times 210, which is the cost. 30 divided by 70 times 210. That gives me 90. My profit is actually 90. Right? We'll test if that is correct, because it's also possible for it not to be correct. We'll test. Now, selling price is 300. If you add 210 plus 90, now this is the original one. that will now eventually be sold at an 80% because it has already been damaged. Now, let's quickly test if it is correct. We're told that they want to make a sales margin, if I'm correct, a gross profit margin of 30%. So it means that our margin is on sales 300 times 0.3 will give us 90. So that tells me that yes, that is correct. Now, this is the cost. What is the net realizable value? Let's quickly solve that out. We're told that this damage inventory, we're told that the estimated selling price of this damaged inventory will be what? Estimated price is 80% of the actual selling price, which is the $300. Now, 80% of $300 will give us 240. It means that my selling price is 240. But then we have a cost to sell. What is the cost to sell? We're told that the person selling it will get a commission of 25%, which is 25% of what he sells, because you cannot be charging me for what you did not sell. So how much did you sell it? 240. So you take 25%. 25% times 240, which gives us 60. Right? Remove it from it. 240 minus 60 will give us what? 180. Now, the value of this inventory, right, it should be between the cost, 210, and the what? And the net realizable value, 180. The lower of these two. Which is lower? 180. So it automatically means that my inventory should be written down from 210 to what? To 180. Don't forget, this 210 is already included in this 1 million. Which means that I just need to write down this 1 million by the difference between 210 and 180. Now, written down value, which is 210 minus 180, is what? 210 minus 180, 210 minus 180 is 30. It means that my inventory should be written down by 30, and eventually the value of my inventory is going to be what? $970. That's that about the question. Please, if you have any question on what we've looked at so far today, please drop a comment for me. Thank you and enjoy the rest of your day.